Hello, good afternoon, or good morning, and welcome to the August session of the NAM Energy Pulse Series. We thank you for joining us today, and we're excited to provide some expert market analytics to guide your procurement strategy. We're joined again by NAM Energy's trusted energy market expert and Vice President of Market Analytics at Environ, Ben Walker. Ben oversees Environ's market analytics practice and has been with Environ since 2014, covering regional energy price trends, custom hedging strategies, and algorithms, price-based quantification, incorporation of on-site energy production, and much more. Today, we'll be taking a closer look at LNG export expansion, gas storage trends, oil supply, and how oil markets are responding to global events, as well as digging into regulatory and interconnection changes across regional energy markets. A few quick pieces of housekeeping before we get started. This session will be recorded, and slides will be sent out within 24 hours of the end of our session today. And if you would like to ask any questions, please feel free to drop them in the Q&A box or the chat. And we'll provide some time at the end to cover any questions that are top of mind for you as you listen and consider your own energy strategies at your own organizations. Thank you so much for joining, and over to you, Ben.
Thank you, Jack. And yes, thank you everyone for joining today and welcome. I do want to reiterate what Jack just said about that question box. It's a feature you don't have to use. But it feels like there's been a lot of changes in the last month or two in kind of the regulatory environment, as well as some of the supply and demand fundamentals. So expecting there might be potential for more questions today. Wanted to start off with some conversation about natural gas, and then we'll get into oil a little bit after this. What I'm showing here is the STEO is the short-term energy outlook from the EIA. And so every month they give a forecast of what gas production will look like. And so you can see they made a forecast in January, which was yellow, and then the black, came in higher than expected, right? So that first half of the year in 2026, in January, the expectation was 108.5, and actuals came in above 110, right? So we were 2 BCF per day higher than expected. And then you can see as the year goes on, the colors just go up, right? And so we're seeing more and more higher and higher production forecasts. Everyone kind of thinks about supply and demand. I think it's pretty intuitive. As there's more supply, prices tend to fall, right? And so I think that balance is fairly well understood. What I want to highlight here is the expectation of strong supply in 2027. When that expectation increases, that's what helps drive prices down, right? So when you see, we get higher and higher forecasts of production for 2027, that means 2027 gas prices have been falling and falling lately. So it's just interesting to see, we went from an expectation around 110 BCF to now we're about 116 BCF. So a 6 BCF per day increase in production. And I want to give you a moment to kind of take your mental snapshot of the BCF per day number. In round numbers, we're about 110 BCF, a little bit more. And so when we start talking about LNG exports being 2 BCF per day or 20 BCF per day, this 110 gives you context of kind of where that sits. So let's talk a little bit about the demand side, and let's talk about that LNG. Golden Pass is really the only LNG terminals coming online in 2026. They have 3 trains, one scheduled for Q1 this year, started drawing some gas in March, April, but really turned on fully in May. You can argue about when the startup was. The full demand didn't hit until May. Startup was earlier than that. So that's about 0.8 BCF per day of new gas demand coming online. Train 2 coming in Q4 has experienced about a 2-quarter delay. Train 3 coming next year has also experienced about a 2-quarter delay. Nothing, I would say, abnormal about this, just general construction timelines slipping a little bit. We tend to see gas, pretty much any energy project, frankly, but especially gas export terminals, they might put the day that for their target of when construction would complete and when feed gas would start, but that demand often lags by a little bit. So it's not too abnormal, but it's also just an indication that some of the gas demand from LNG has just slowed a quarter or two. Again, that just means our demand is a little bit lower. So as you compare that with our higher production, which we talked about the previous slide, in a slide or two, you'll see what that's doing to storage. So Golden Pass has had a little bit of delay. The total LNG export capabilities of the U.S. before Golden Pass was about 19 BCF. Once you get those trains from Golden Pass producing, we're going to go up to about 21 BCF per day, which is about a 12% increase. And again, thinking back to that 110 number, it's like a 1.5 increase on kind of the total supply and demand balance. But that's not the only LNG terminal that's coming online next year. We see Port Arthur and Rio Grande both scheduling new export facilities in 2027. Both of those have also had about a 1-quarter delay in the last year-ish. Maybe they said it was going to be Q1 2027, and now it's the first half of 2027. We still don't have firm guidance, but again, as that slipping happens, we just see that delay still coming, but a bit later than expected, which is helping soften prices. We also saw Freeport, a big LNG export terminal, down for maintenance for July and August. I don't know if it's actually back up yet. It's scheduled to be up here at the end of the month, which is 2 BCF per day of demand coming off for 2 months. So demand is softening. The other reason that demand is softening is El Nino. So if you've been paying attention to any sort of weather news, you know that we are in an El Nino, and we've been in one since June. There's a 95% chance that this El Nino becomes abnormally strong, which is just a measure of the temperature of the ocean. But it's likely to be a very strong El Nino, and then it's very likely, 97%, to persist into next spring. Generally, El Ninos are bearish for demand. We expect warmer temperatures in winter from El Ninos, and warmer temperatures mean we need less gas for heating. Again, that's bearish for pricing, right? So we're starting to see, honestly, kind of 3 different factors all pointing in the bearish direction: higher production, slower LNG, and then less demand from the temperature changes from El Nino. And all of that is combining into a very strong storage position. So on the left, this is a storage graph you've probably seen many, many times. I would like to point out the yellow lines in the 2024 winter and the 2025 winter. So you can see here the yellow line didn't quite reach 4,000. Our all-time record in gas storage is 4,047 BCF. We didn't quite cross that 4,000 line, but we got really close to it in 2024. We got really close to it again in 2025. That's a very, very strong. I think those are like 4th and 3rd most gas ever in storage. I'd have to go double check. But once you start getting into there, it's really just 1 week difference between whether you hit 39.25 or 39.50 or 39.75, and you kind of jump in the rankings a little bit depending on whether you get that extra week of warmth. So with all of the bearish factors we talked about earlier, we're expecting to fill storage pretty close to that 39.50, 39.75 later this year. So that's the dotted projection that you'll see to kind of finish up 2026. If you pair that with the supply and demand balance for 2027, right? We just saw production numbers go up. We saw demand softening. There's really nowhere else for the gas to go except storage. And so 2027 is setting up to inject an additional 350 BCF into storage, which would take us from, call it this almost 4,000 to call it 4,300. Again, our max is just under 4,050. And so we could see a 6%, if nothing changes, we could see a 6% new record of gas demand. Demonstrated natural gas, a 6% record of gas storage. I misspoke. Demonstrated gas storage is around like 4.28 TCF or 4,280 BCF. So we would be challenging kind of the demonstrated natural gas capacity. I personally don't think that that's going to happen. That's what all the like economic supply and demand, like everything is, all those factors are pointing in that direction. I think it is less likely that we will hit a new storage record. I think it is more likely that you will see spot prices drop and you will see producers choose to hold their production back. So natural gas producers, they can drill into the ground, they can kind of fill the well, get it all completed, and then they can just cap it and keep it ready. So they do all the capital expense, they do all the, it's not construction, but that kind of construction equipment, getting the drilling done, all that, and then they just hold it in reserve to turn on the spigot when gas prices are more favorable. And there's a technical distinction in the industry whether it's drilled but uncompleted well versus a non-turned in line well, which we don't have to get into, but there's some level of, there's a spectrum between they've done a lot of the kind of high capital expense efforts and they haven't yet turned on that production. So what I anticipate is that you will see prices drop in the short term and more wells will kind of hit this, we're halfway done, we're most of the way done, all the CapEx is done, but we're not actually bringing production online yet. That's my personal opinion. You could disagree or you might differ, but we're kind of set up for near-term prices to have a lot of bearish indicators on them. One more that we didn't talk about yet that's a little bit more of a wild card is associated gas. So if you've been on this call before, you've heard me talk about associated gas as the gas we get out of the ground when we try to go for oil. So we're going after oil, we kind of get the gas by accident. The interesting thing is that associated gas rises and falls with oil prices. So higher oil prices means more associated gas, and lower oil prices, less associated gas. Associated gas, I'd have to go double check. It's like 15 to 20% of our total gas supply comes from this associated gas. War in Iran, Strait of Hormuz, everyone knows this item that the oil prices are elevated, not elevated as much as they might be. But there's a fair amount of gas production that might be coming from oil. So let's just take a minute to look at some of the oil and demand figures. On the left, this is the world crude oil production. So when the war in Iran started, not only can we can't get the gas, we can't get the oil onto the ships because they can't get to the Strait of Hormuz. And so at some level, that oil is just not really, they fill up storage locally, but then they just don't produce it because they can't get it out. So not only does that occur, but also you can have their military targets, right? And so you actually might see some production facilities get damaged. So for those two reasons, everyone expected oil production to fall when this thing started, which it did. So you can see we went from 106 million barrels a day to just over 100 million barrels a day, year over year change. What was surprising to people was that the demand also dropped more than expected. So there's a concept in economics called the elasticity, which is as the price moves, how much does demand move? In general, this was thought to be an inelastic relationship, which means we need oil to drive cars, to drive jets, and kind of the price of oil is somewhat immaterial to that demand. You might be able to find short-term solutions, but if people need to fly for work, they need to fly for work, and they're going to pay the extra $100 on that flight ticket. And so the assumption was that oil demand wouldn't drop as much as it did. It dropped quite a bit, right? 104 to just under 103. Some of that drop is from switching from gas vehicles to EVs. A lot of that is actually China. They had stockpiled quite a bit of their own strategic reserves and just stopped buying as much oil. And then we also saw strategic reserves depleted in order to kind of cover some of the supply gap. And so I think that's, I've got another slide on that next. I did want to compare that, you can see the forecasts going up. This is why we think there's potential for more associated gas coming out of the ground in 2027. These are global figures. Just I wanted to throw on the domestic figures for you. Domestically, the U.S. has not slowed down production. That's the graph on the top there. Our oil production continues. We're not restricted by the Strait of Hormuz. We haven't had attacks on our domestic soil that have reduced our ability to produce oil. And so our production has continued. And our demand, we're not quite as responsive to these new higher price signals. So our demand on the bottom there has been relatively flat. I mentioned the strategic oil reserves and oil storage, so wanted to just show you some images on this. On the left, it's the commercial reserves and the strategic petroleum reserves stacked on top of each other, and then on the right, it's each of those just plotted on its own. Pick whichever one you find more impactful. The big takeaway here is what we covered last month, which is we are at 42, 43-year lows in terms of the amount of oil we have in storage. We've seen a lot of countries do this where they are using their strategic reserves to try to cover for the production drops. And so that's why we've seen oil prices actually pretty muted. Excuse me. We've seen some relatively minimal price increases. There's expectations. You do the numbers, try to figure it all out. 150 to 200 was kind of the predicted oil price based on how much oil restriction Strait of Hormuz. And we haven't hit those oil prices, right? We've been much lower than that because of these strategic reserves. The other interesting concept there was because of all the tariff and kind of trade conversations that had been happening 2025, there were a fair amount of oil tankers at sea that were full of oil, kind of waiting or trying to figure out how to get around tariffs. And so there was kind of like an extra storage facility, if you will, kind of just on the oceans when this war started. So kind of a bonus there. The other thing that's of interest or of note is as we start to deplete our strategic reserves, we're pulling on infrastructure that hasn't been tested in 40 years. So we're actually starting to damage some legacy infrastructure. You could argue it's a good stress test, but it's also, of note that we need to figure out how to fix that. All this oil withdrawal, we anticipate we need to increase production to refill these storage reserves. And again, that could push oil prices up, which comes back to the natural gas, which helps deflate the prices there. So that's the oil, natural gas situation. Again, if you want to throw a question in the chat, please feel free. I'd love to talk to you to your question now. If you want to follow up later, happy to do that as well. But we're going to pivot to power and some of the regulatory changes. So if you were a new facility trying to come online 2000 to 2025, that 25-year period, generally we didn't see a lot of large load. And so most of those loads were smaller in size. There was very minimal grid growth. And the generation queue for new power sources was like less than 3 years. And so under this environment, every new person who wants to connect fast, and they want guaranteed reliability. And the utilities and the markets were able to provide that. Grid upgrade costs were low, and the cost allocation was shared. Today, with these large loads and data centers, we are seeing very different things. So we're seeing that the average load of a new facility looking to connect is huge. You have PJM is expecting to go from 168 is our current gigawatt peak. We're going to go to 240 gigawatts by 2040. ERCOT, nobody really trusts their numbers, but they are currently at an 80 gigawatt peak, and the expectation there's 400 gigawatts of data centers in the queue asking to connect. So we have really, really large load that's looking to come online in the middle of huge grid growth. So there's that, and that's kind of the cause of, but there's this big upslope on demand and for power forecast, which we covered last month. And the timelines to get new generation on is much longer than they were a few years ago. And so what's happening is kind of the markets and the regulatory groups that be are starting to question some of these long-held beliefs of, yes, we can connect you fast. Well, maybe we can't do that anymore. Yes, we're going to guarantee reliability to new load. Maybe we can't do that anymore. And then because of the high upgrade costs, they're starting to say, we used to just have a shared kind of socialized cost of grid upgrades, and maybe we don't do that anymore. One of the things that led to was FERC in June issued what's called a show cause order. They basically said, hey, all you markets, there's 6 under their jurisdiction, please look at your large load process and do these 5 things, right? Of make sure that people can connect efficiently, that there's a transparent process, and that you're analyzing and not doing cost shifting and all that stuff. And so the response deadline was yesterday. And so I wanted to just go through a few markets that have responded to this. You'll notice the 6 markets there that this applies to. ERCOT is not in that list because ERCOT, Texas, they don't want to be subject to federal oversight. So their grid is entirely within their state borders, which allows them to kind of dodge the FERC request. But as we go to this next slide, I did want to show what ERCOT is doing. The three markets I'm not showing got pretty good grades. If you use the schoolwork example, like they were fine passing grades. But I think ISO New England, New York, and PJM are of interest from the market side. And then ERCOT's doing their own thing. So very briefly, ISO New England's whole thing with new data centers is you either bring capacity with you or you bring flexibility. And that means you bring the new generation, or we're going to turn your power down or off if the grid needs us to. And so that was their approach to adding data centers. New York ISO put a moratorium. They just said no new data centers for a little bit while they kind of figured out. ERCOT and Governor Abbott specifically, about a year ago, was like, everybody come to Texas. We can, we want to be the data center capital of the world, or whatever phrase he used. There was some public backlash that has been building on that. But ERCOT started this, what they call batch zero process, to review and understand all the large load that might want to come online. They did a whole bunch of planning throughout the summer, even earlier, but throughout the summer, there was a whole bunch of planning. They launched on August 3rd. 200 gigawatts of new load tried to join that queue. Again, ERCOT's current max peak is like 95, 92, or whatever the number is. That's a huge, huge increase. And so August 3rd, they launched that process. August 4th, Governor Abbott was like, time out. We're going to pause and do an audit. Somebody, a stakeholder, was kind of grumbled and quoted as saying, he's injecting maximum uncertainty into the process. In response, the ERCOT expected load growth for year over year from 2026 to 2027, it dropped from 14% to 6%. So just with that one pause, we're seeing potential 8% drop in electricity demand next year. I'll note that hasn't quite filtered down into prices yet. We're still seeing prices less movement than you might expect given that news. But I think there's a bit of a wait and see. Is this unpause going to happen soon, or are we going to remain in this period for a while? PJM, they kind of copied ISO New England's homework. So they came out with this IRAS, Interim Resource Adequacy Service, August 13th, which was basically the same thing, right? Bring your capacity or bring flexibility. I'll note that there's close to a dozen efforts that PJM is undergoing to try to solve some of these various problems, from capacity auctions and backstop auctions to their cycle one and infrastructure ready interconnection queue stuff. There's a lot we could go into there, but very briefly, this is kind of their approach to the data center problem. And then I wanted to also give an update on some of the capacity changes that are coming for these each markets. So going back to the top, ISO New England, they have this CAR, capacity auction reform process. It's continuing. They're going to do this 2-year phase in, which has been known for a while. They're currently arguing about how to count storage and these gas plants that might be on interruptible gas supply. And so if you're a power plant and your gas supply gets cut off, you can't provide capacity. And so they're trying to figure out how best to account for those. New York ISO, they came out August 12th and said, we've got 40 things we want to try to do next year. Because of this FERC data center stuff that we need to focus on, we're going to cut 28 of those 40 and reduce the scope of the things we are going to look at outside of data centers, just because this is going to take so much of our time. So people are pretty grumpy about that. Some of the things they cut were capacity reforms and were energy market things. And I don't think that's finalized yet, but definitely interesting to see some of those regulatory events play out in New York. On the ERCOT side of things, I think, again, we mentioned this a couple times on these sessions, but they are likely moving from a 15-minute 4CP approach, which is current, to a 12CP approach that uses a 30-minute window. The deadline for comments was last week. Comments came in. We expect them to file that kind of final request in December this year. There's also been this 765 kilovolt conversation of transmission lines around ERCOT. which is like a $9 billion project. It's been around for 2 years, and they're restarting those. Lastly, I was going to just take a little bit of time to talk about the PJM. I'm going to take just 1 minute to do this last slide for you guys, which is the new PJM capacity auction results came out end of July. We cleared at the cap again, so that's this was the recent auction right here, this 28-29 timeframe. The collar protected 40% of the spend, and so we're seeing some pretty significant protections on consumers from those collars. There's one more auction coming in December, which still has a collar in place. Everybody's real grumpy. Frankly, this is not achieving the goals that PJM should be trying to achieve. And so part of it is they're going to do this backstop auction. That is a kind of taking data centers out of the capacity auction and running their own separate thing for a 15-year commitment starting in September. The results of that will be released in December. 1 week later, this 29-30 auction is going to be run. So we're not going to have a lot of time to kind of incorporate that backstop auction into the next auction results. And then there's a whole bunch of market redesign conversations happening of basically PJM and FERC recognizing that this doesn't really work. So FERC is keeping a pretty careful eye on PJM and saying, like, you guys need to shape up. And we'll see. There's a deadline for September for PJM to initiate reforms, and then FERC said, if you don't do it, we will. So PJM's got a couple weeks to figure that out and get that information out. That's all I've got. Jack, anything you wanted to add?
I was going to say sounds like there's a lot stacked in the next few months between the PJM backstop auction in September, 2029-30 capacity auction in December, a week after those results, plus the FERC show, cause response that we're due on August 17th. Of everything that's on the calendar right now, Ben, which one of these things do you think moves the needle the most for the buyers? And is there anything that we should be doing before it lands?
So the thing that moves the needle the most is actually all of the things we started at the top with the supply and demand bearish drivers of natural gas. You're actually, like, despite all these load growth potentials, you might have like a 12 to 18 month window here in the short term. Things don't look too bad. There's just a lot of, you could call it chaos, you could call it uncertainty, starting in that like 29 plus time frame. So it kind of depends on your organization. If you don't want to deal with that chaos, you could absolutely look at hedging some portion of your spend now. But it's a lot of, we don't know what the market looks like in 2030. And there's just a huge range of outcomes. So just planning as best you can and alerting your senior leadership to say, my budget, I might know it for 27. I can't make predictions for 29, 30, 31 right now, just because the uncertainty is so large.
And that's completely fair. Well, we really appreciate you sharing your insights with us again this month, Ben. Really, really helpful as we think through our energy strategies. Our next session for the NAM Energy Pulse will be held on September 15th, same time, noon Eastern time. So we hopefully look forward to you all joining us again for that session. As I mentioned before, slides will be sent out after the conclusion of this webinar. And we thank you all for joining us today. Hopefully the insights were helpful as you're thinking about your energy buying strategy.